Hey guys, this week we're going to discuss on fraud and error and corporate governance and external auditor. Now, let's talk about what is fraud. What is fraud? It is referred to intentional act by one or more individual among management. And also, it is intentional use of deceit, a trick, or some dishonest means to deprive another of money, property, or legal right. These are the types of fraud. First, financial statement fraud. Second, asset misappropriation. Third, intellectual property fraud. Fourth, theft or infringement of third party. Fifth, money laundering. 6. Investment scheme fraud. 7. Insurance fraud. And lastly, computer fraud. What is error? Error refers to unintentional mistake in financial statements such as mathematical mistakes in the underlying records and accounting data, misinterpretation of facts, and misapplication of accounting policies. Next, how to plan the fraud risk assessment. First, identify and evaluate fraud risk factors. Second, identify possible fraud schemes, risks, and scenarios. Third, prioritize identified fraud risks. Fourth, evaluate whether existing controls exist are effective. And lastly, risk treatment. Next is fraud diamond theory. First, let's start with pressure. Excessive pressure exists on management to meet the financial target or financial stability of the company. Personal financial obligations, interest in the company among the management may create pressure on management or employees to commit fraud. Next, excessive pressure on management to meet the requirement or expectation of third parties. Next is opportunity. Nature of the industry and business provides opportunity the company to engage the fraudulent financial reporting. Ineffective monitoring of management, for example, ineffective monitoring by audit committee as a result of domination of management by a single person. Lack of good internal control, high turnover rate of staff or senior management, and effective accounting system. Third is attitudes. Excessive interest by management in maintaining or increasing stock price of entity. Promise by management to achieve certain target to analysts, creditors, and other third parties. Low morale among senior management. Lastly is capability. The traits and abilities to be the right person to succeed in defrauding the company. It is where the fraudster recognizes the particular fraud opportunity and ability to turn it into reality. Next, we're going to discuss on the responsibilities of management and auditor. In management, the primary responsibility of the management is to take reasonable steps to prevent and detect fraud and error within the company. This could be done through installing effective accounting system, installing an effective internal control system, establishing an internal audit function, appointing audit committee, and establishing and implementing code of conduct among the employee and management. As for auditor, the auditor to express an opinion as to whether the financial statements are true and fair view or not, and have been prepared in accordance with identified financial reporting framework. An audit also must be conducted within the Malaysian-approved auditing standards that is designed to provide reasonable assurance that the financial statements are free from material misstatement caused by fraud and error. When obtaining reasonable assurance, an auditor should maintain an attitude of professional skepticism throughout the audit, to assess or identify the factors related to fraud occurrence and perform procedures to detect the fraud. Next is the reporting responsibilities. It is to regulatory and enforcement authorities. Next, the auditor's duty of confidentiality would ordinarily preclude reporting fraud and error to a third party. Also, withdrawal from the engagement. The auditor may conclude that withdrawal from the engagement is necessary when the entity does not take the remedial action even though the effect arising from fraud and error is immaterial. Lastly, on receipt of an inquiry from the new auditor, the existing auditor should advise whether there are professional reasons why the new auditor should not accept the appointment. Next, we're going to talk on corporate governance. What is corporate governance? Corporate governance is a process used to direct and manage business and affairs of the company towards enhancing business prosperity and corporate accountability. What is the objective of corporate governance? It is to realizing long-term shareholder value and at the same time taking into account the interests of other stakeholders. These are the concepts of corporate governance. First, transparency. Second, accountability. Third, fairness. Fourth, social responsibilities. Fifth, responsibilities. And lastly, independence. Why does corporate governance important? First, it is to help streamline the process and gives people accountability. Second, corporate governance is to help the decision-making process. Third, a main goal is to clearly explain to the board, the stakeholders, and the shareholders what their duties and responsibilities are within the company. And lastly, with knowing those roles and responsibilities, the people within the corporation can understand what they are held accountable for. These are the basic principles of corporate governance. First, we're going to start with governance. Good governance depends on effective interrelationship between board and management. Next is board. Successful board is a board which is able to establish good leadership, stewardship, and control. Next, we're going to talk about good leadership. Successful board enhances the competitiveness of the company and shareholders' confidence. Thus, it will refer to good relationship with the management and also the employees. In stewardship, the board as responsible person of the company assets have a moral and statutory obligation to work with management to add value to those assets by contributing in several ways, for example, strategic planning and risk management. Next, we're going to talk on control. It is the monitoring is the third component of principles and best practice for the board of directors. The company is bound to fail if the company not do well in monitoring and control, although the company have the best systems, procedures, and technology. Good corporate governance requirements relating to directors' responsibilities. Directors must act in the best interest of the company, care and diligence in their functions, and in dealing with statutory duties. Directors must act honestly and avoid conflict of interest. Directors also must act according to M&A, Companies Act, and Securities Industries Act and comply to the listing requirements. Next, we're going to discuss on the role of Audit Committee. First, to assist directors in discharging their statutory duties and responsibilities. Second, monitor company activities. Third, increase public confidence. Fourth, support the audit function. Fifth, monitor disclosure requirements. Sixth, satisfy the board that adequate attention is being given to risk management. And lastly, satisfy the board that internal control exists and are effective. Next, we're going to talk on advantages and disadvantages of audit committee. First, on advantages, it is to improve the quality of management accounting and it is well placed to criticize internal functions. Second, it is lead to better communication between management directors and external auditor. As for the disadvantages, first, it is afraid that their purpose is to cash management out. Second, non-executive directors being overburdened with detail. And lastly, consisting of two separate board of directors. Thank you for listening. See you guys next week.